Tom Lee, he is the managing partner and head of research at Fundstrat. If you had to go on Team Cohen, which I guess is the Mets, and Team Einhorn, like I'll call that the Brewers because he's from Milwaukee, which team would you be on, Tom Lee?
Well, I hope I don't get judged, but I'd be on the Team Mets and Cohen.
Why is that? Lay it out.
Well, I think that the reason the idea of cuts was being rolled back was the January and February inflation reports globally showed inflation was accelerating. And part of that is a statistical aberration. There's just some really poor seasonal adjustments that take place. The March CPI reports coming out of Europe have shown a big collapse from those January, February levels. Like Eurozone, it's back to 2.4%. The March CPI for the US is coming out next week, which is April 10th. And by the time the Fed meets in June, there's going to be a total of 3 inflation reports, March, April, May. I think by then, markets are going to be a lot more confident that inflation is falling, and the 3 cuts actually may be too low. There's a possibility there's more than 3 cuts this year.
Okay. Wow. I tweeted out a poll yesterday, and I think we might get less or maybe none, but that's why you do what you do, and I sit here on this side of the camera, Tom. If we get 1 cut, if we get 2 cuts, if we get 3 cuts, if we get 4 cuts, does that change your end-of-year S&P target? I mean, does another 0.5 percentage point off the Fed funds rate matter to the S&P 500 in the short term?
Brian, I think the number of cuts won't matter as much as the reason the Fed is titrating its cuts. If the Fed is titrating its cuts because the economy is showing resilience, so it's strong, but not necessarily inflationary, I think the market would take that as quite dovish because it's really a Fed trying to manage the business cycle. If the Fed is cutting back its number of cuts because inflation is reaccelerating, that would actually be incrementally bearish. So I think that the rationale actually is more important than the number of cuts.
Okay, well said. Tom, I want to switch gears a bit. The Federal Reserve, we've been focused on inflation for 3 years, but the Federal Reserve's dual mandate also looks at job growth. And a new article today in the Wall Street Journal highlights a rather curious trend in the difference between the 2 ways that the federal government measures employment. And if you read between the lines in the Journal's article, it implies that much of our recent job growth, maybe a majority of it, is due to immigration. Much of that, of course, would be undocumented immigration and those seeking asylum. In fact, the CBO, Tom, just raised population growth estimates to account for the millions who have crossed the border in the last few years, leaving out all political arguments about the border. We're talking about the markets here. Do we care? And Morgan Stanley alluded to the same issue kind of yesterday. Do we care where the job growth really comes from when we're looking at markets and the Fed?
Brian, it's objectively, it's actually a good thing because we know the Phillips curve's kind of been busted. That's supposed to measure unemployment rates and wage inflation, and we've had unemployment sort of pinned at these levels and wage inflation isn't accelerating. So it shows that we're adding jobs, we're adding to the worker supply and actually adding to aggregate demand without creating inflation. And on balance, that's quite positive. And does it matter where this labor supply is being filled? It's a great question. But as you know, I mean, the U.S. is essentially a nation of immigrants anyway. So I don't think necessarily immigrant labor driving, wage growth and demand growth and filling jobs is a bad thing.
Now, I know stocks have been under some pressure the last couple of days, and it's actually brought the Russell 2000 into oversold territory. But this is actually a good setup. This is the 30-minute daily RSI, and as you can see here, we are oversold. Generally, it shows you that there's going to be a positive risk-reward asymmetry, meaning if good news happens, stocks can rally. And in fact, this happened several times since the start of this year, and as we highlight here, I mean, it's always been a good time to be adding to the Russell. So without actually knowing catalysts, and I'm going to describe 5 catalysts, I think it makes sense to be buying the dip here.